Hi everyone, welcome back to Be Rich. Yes, I'm recording from my car because today is one of those days when there's too much happening in our building and we were unable to record in the studio because there's a lot of construction happening on a floor above us. So with all the drilling and all the other noise, I thought, and Rupesh also felt, who's sitting next to me, that it's better that we sit and record it in the car park and hope that we get some kind of better audio quality. I don't care too much about the video. As I always say, I'm here more worried about the audio, and I hope the audio has come out well and Rupesh is able to get us good clarity on this. If not, I do apologize ahead of time before the video, so don't worry about it. Hopefully tomorrow we'll be back in the studio. Or if you do enjoy this audio and you do enjoy a change in scene, let me know. Maybe me and Rupesh could do this now and then, where we go out somewhere, have a cup of coffee, and we record a video for you guys. What did I want to talk about today? Well, there are a couple of things which were there brewing in my mind. Well, as I was recording today, the market is nowhere. It's going up and down as expected. I was looking at Tata Motors in the morning, and as now Natco looks also interesting. And I was reading this interesting comment one of you guys had shared in our group, in our 52-week challenge group on Instagram. And the comment reads as this. It says, I had previously bought 780 shares of Jai Prakash Associates Company at an average price of 79.6 rupees. I stopped buying it after November 2011 and even stopped watching it for 13 years. Now the stock is priced at 7 rupees 33. That's a 90% loss. I bought the company. The market capitalization was over 2,000 crores. It was actually trading at a 52-week low, was supposedly in value for me, but the legal battles has shredded the company share price to pieces. Now I'm waiting for someone literally to revive the company, but I'm no need of money urgently, so I can hold it. Fingers crossed. I urge my fellow subscriber guys not to make the same mistake. Don't stop following a stock even if you buy it. Read about it. Continue searching news bits about it and be informed. Ignorance is not bliss and it can cost us dearly. Take care and have fun. And this is very true. And I thought I'd talk about this, especially what is happening. For example, why it's important to keep an eye on the news. If we take, for example, what's happening in the diamond industry. A few years, decades back actually, it came out that lab-grown diamonds was a possibility. And finally, lab-grown diamonds started coming in the scene. And when the initial few lab-grown diamonds did hit the market, they were not of great quality and people scoffed at it. But the thing about human ingenuity is, two things human beings do is, one, when we discover something, we try and make it better. And another thing is which we do relentlessly is we try and make it cheaper. And that moment has arrived for lab-grown diamonds. De Beers, the world leaders in diamonds themselves, have said the days of natural diamonds being super expensive are long gone and it's over. And the prices of natural diamonds have corrected by 50%. And this year itself, it's down by 23%. And majority of the diamonds being sold nowadays are lab-grown diamonds because for a normal user like me and you, it is very difficult to distinguish between a lab-grown diamond and a natural diamond. You need a special machine that does that. And that machine measures the nitrogen content in the diamond because lab-grown diamonds don't have nitrogen in them and natural diamonds have nitrogen. And there's a whole bunch of other things which they measure on, which for a layman, it makes no difference. As far as you and me are concerned, a diamond, be it made in the lab or be it natural, looks and feels the same. And a diamond which would have cost you, a natural diamond which would have cost you maybe $30,000, now you can get it for $3,000. So that's almost a 90% reduction in cost. And that's a phenomenal change in the scene. There are two things to keep in mind. Diamonds used to be looked at as two things. One, it was looked at as a status symbol. People used to buy a diamond, and the larger the diamond was, the wealthier you were, and the more status you had. So it was something to show off. And the other reason was it was something to hedge against inflation, like gold. People would buy a diamond and hold on to it because it's so small and it's so expensive. And if you hold it for long enough, it becomes rarer and rarer because diamonds were hard to find and diamonds would appreciate in price. Not anymore. And the days of diamonds doing any of those two things are long over. And even the Tatas, Noel Tata has said they plan to invest heavily into lab-grown diamonds in India. And Tanishq and Mia and Carrot Lane, all of them will start showing lab-grown diamonds because the market has shifted. Because you cannot discern anymore. Now, almost 70 to 80% of all diamonds sold around the world, especially in the US, are lab-grown diamonds because they're just being cost-effective. Now, there's two things to take from this. So what does this mean? Like the case we were talking about, Jai Prakash and Associates. If you are, let's say, a diamond merchant, you are buying lots of diamonds and you're hoarding them and you're going to keep them and sell them and trade in diamonds. Your days are doing that and having a profit margin, high profit margin, probably a long over. So if you're in that business, it's time to look and pivot and move and change. If you don't, you may miss the bus. Or if you're, let's say, you are like a Tanishq, you are a Tangamai, or you are a Carrot Lane, then there are two edges to this. It's a double-edged sword for you. Because yes, diamonds used to be high margin and you could make a lot of money on it. And high affluent people used to come and buy these into your store. Now they will not be walking into your showrooms and buying this because it's lost its splendor, as they say. But the flip of it is now the cost of diamonds have become cheaper. Entry for layman to buying a jewelry made of diamonds has become easier. So that means your market scope has improved and your market is expanded. So it is the way you look at it, the way you apply it, which makes a difference. So that's the reason I wanted to talk about diamonds, especially when it comes to this feedback from one of our followers, one of our tribe members, that he had bought J. Prakash Associates and he's forgotten about it for 13 years and now he looks at it and he's like, oh my God. And now he's hoping someone will revive it. This is why it's important, more than worrying about average cost of buying a share. Like on Instagram, I had put up, someone had bought Tata Motors today, and the reason they bought it was they're trying to bring their average cost of investment down. And I said that's not a very wise thing to do. That's like looking at your bank balance, your current bank balance when you're negotiating salary. There are two separate things. It makes no sense looking at it. Because let's say I've been buying Indian hotels. I bought Indian hotels when it was 30 rupees. I bought it when it was 60 rupees. I bought it when it was 500 rupees. And I'll keep buying it as long as I see value in it. If I keep looking at my average cost, I can never buy Indian hotels again at 60 rupees. Unless something happens like tragic as what happened in Bombay. And I wouldn't sit and pray for something like that. It's not going to happen. And I would rather that you focus on your price to earnings and making sure you buy in value. Whatever you bought it already in value and it's in your kitty and it's great. And you should not focus on the price, the average price, but what you should focus on is price to earnings. So if the price to earnings of a stock makes sense, then definitely consider it and keep buying it. Don't look at your portfolio constantly and look at the price, average price which you bought, which is no sense to us because we're not traders. We're not trying to buy it at an average price for X amount and then in a couple of months later or in a week later try and flip it for a higher volume or a higher price. That doesn't make sense. That's not value investing what you're doing. That is trading. And people who do trading do it for another reason. That brings me to the third comment which I wanted to pivot to today, which is about trading. This is what one of our tribe members had messaged on our group, right? He's a trader. I have nothing against trading, right? I don't have anything against traders. If you know what you're doing and you can do it well, respect to you. I can't do it. I'm not good at it. And nor am I interested in it. So those three things doesn't matter to me. But if it is your interest and you're doing great and you know how to manage your risk, fabulous for you. So what he had written was, he had said, partially disagree. Until you never spent time to gain knowledge or experience in any instrument, it's difficult to get success, which is absolutely true. As much as risk you have, the rewards can be high. Possibly true. If you're not ready to take calculated risks, still Moon and Mars mission will only be a dream. Absolutely true. Myself is into future and options since 2017. A lot of challenges until I understood the core concept, then slowly moved to from the negative to the positive side. Now I can happily say that I am paying tax in good numbers for my future and also income for the past 4+ years. Kudos and respect to you. But the thing about future and options is, it's something you have to learn. Like anything, it has high risk in it, right? Not everybody wants to be a stuntman. Not everybody wants to ride roller coasters. Everyone has a different risk tolerance to it. And future and options and value investing are two different things. The reason why I say it's two different things is, one is about investing and creating passively wealth. The other is like a job. It's like if I'm a fusion options trader, I cannot do passive value investing, right? I don't do value investing all my day. I don't do value investing day and night. I'm not logging on and checking numbers whenever the market is open. I have a list of stocks which I found to be of value. They have a moat. I believe in the owners of those companies. I believe in the business. And then what I do is I keep, as long as the value is there in terms of price to earnings, I keep opening the market once in a month for some of you. Some of you maybe daily, depending on your tiffin coffee range, whatever it is. And you invest a little bit and you switch off. I don't spend my entire day looking at the screen. But if you're a trader doing future and options, your livelihood is this. I cannot do future and options on the side. You cannot be working a full-time job and doing future and options. So that means it's your vocation. That means that's what you study and work towards. Like how you study and become a software engineer. You can study about future options and become a full-time trader and make a livelihood out of it. Nothing wrong in it. There are a lot of people who do it. I don't recommend it because I find I cannot do trading as a part-time gig and call that investment. It doesn't work. And you cannot create long-term wealth doing that. If you do something, you have to be 100% committed to it, and you have to be willing to learn and spend your time doing it and honing it and learning it. And future and options is something which will rob me of that time, which is very important for me, especially at my point in life where I'm almost nearing 50. Dedicating time now to learn future and options and then do it will become a monumental task for me because of all the other responsibilities I have in my life and the commitments I've already promised to do and take part in life. I cannot carve out time to do future and options and learn it like the way you're talking about it, right? And I can't suddenly take a pivot in my job or my vocation to do this either. I have to be committed to what I've already done because I've spent time learning it and I have to do this. But in value investing, that's not true. In value investing, like Peter Lynch said, 7th grade maths is good enough. Basic understanding is good enough. Even children can do value investing once they learn the basic tenets of it, in the sense that understand a business, how it works, and look at the basic numbers and understand it. Then as long as value is there, you don't need to keep on checking it on an hourly minute basis. You log on, you invest, and you keep moving on. Because the long length of time which you're investing in, it lowers your risk also, which future and options doesn't do. Future and options is the exact opposite. Yes, you can make phenomenal money. You can also make phenomenal losses. And we know about this. So I agree with that comment from our user, from the member of our family and our tribe, that yes, he's been lucky enough to navigate this minefield, which is future and options, and he's making a profit. I respect him for that, and I wish him the best. But would I recommend that all of us try and do this? No, I would not recommend it. And it's highly risky, and unless you have a great teacher, like in anything, like driving even, and the risk which is involved in it, it's phenomenal. And we have read so many sad stories. And there's most people who have lost money have not even come out and said it. When SEBI themselves, who are market regulators, are saying 9 out of 10 future options players are losing money, that itself speaks volumes. That means most stories where people are losing money are not even reported. So keep all this in mind. And that's what I wanted to touch on today, these 3 things. And I hope you found this video informative and entertaining as always. And do like and share this video if you think people in your surroundings and friends and family would find this content interesting. Nothing much more else to say, and I'll see you tomorrow with another video, hopefully from the studio, or at least me and Rupesh will manage to do it somewhere and get this content to you. Thanks for watching the video again. Bye.
Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.